I'm Derek West, the host of Finance Squared, the very channel that you're watching, and investing $10,000. Well, one would think it's technically an easy task to accomplish. Open an investing account, buy a cryptocurrency, a stock, a bond, etc. But that's where the myriad of options hit you between the eyes. There are just so many things to invest in. Some are really risky, and you'll lose money for sure, except for a really lucky chosen few. Others are really safe, but won't keep up with high levels of inflation that our own government is telling us is coming. How can we pick an investment that will beat inflation, but also not be really risky, like a penny stock or one of the seemingly millions of cryptocurrencies out there? Well, there are options. Let's take a look. Before we jump into the deep end, don't forget to lovingly, tenderly, and ever so gently smash that like button for the YouTube algorithm. And if you're so inclined, subscribe and turn on post notifications so you don't miss a second of the action. Now that we got that stuff out of the way, picking an investment is all fun and games till someone loses a grand, discouraging you from taking action on your personal wealth and financial future, as well as taking you right back to where you started, saving your money so you can pick another investment. Well, I did some research to find the best ways to invest $10,000 in 2021 that will neither be too risky or off the wall. Let's take a look at the options that you have if you need your money to grow in the short term. If you're looking to use the money you invested in less than 2 years, a couple options would be online savings accounts and money market accounts. Short-term investing and long-term investing have different strategies, all of which revolve around the interest rate and potential investment return from each strategy. In most cases, interest-bearing accounts, such as certain online savings accounts and money market accounts, are relatively low risk compared to other investing options, such as investing in the stock market or even the bond market, and especially in really speculative investments like crypto. In the long run, that's greater than 5 years, more speculative investments will most certainly be more profitable, except maybe crypto. The jury is still out on that one, but they will most definitely be more profitable in the future. But in the short term, getting a predictable interest rate back will more than certainly be the best way to grow your money. The only catch to that is there is very low returns associated with such tactics. You can expect about a 0.5% return on your money with online savings accounts, which frankly is much better than a traditional savings account. But in a world where the stock market has, averaged a 7 to 11% yearly return, it's not that much. So admittedly, that is not very exciting, and also will not likely beat inflation. Well, it's certainly not going to beat inflation, as inflation was about 2% last year, which, as we're likely to find out in the coming months, was child's play. But fear not, there are other options out there for the short-term investor. For example, bonds. James bonds. Silly joke, I know. But bonds. Why bonds? What are bonds? Well, a bond is effectively you making a loan to a company or a government. Way to turn the tables, am I right? Instead of you taking out a loan or a credit card, you are issuing it to someone else. Very cool. The company or government that pays you, the bondholder, a fixed interest rate until the bond matures. A fancy term for it being paid off. Bonds will almost certainly beat any online savings account or money market account like a drum. Most of them can get you a 2% interest rate. If you're willing to be a tad bit more risky with your money, you can get higher returns as well. The riskier bonds are from corporations, typically that are at risk of defaulting on their debts. But there have been cases of governments defaulting on their debts as well. The most common bond strategy involves buying bond funds, which are essentially mutual funds that only hold bonds and not stocks. And those bond funds typically only own government bonds, which are issued by stable governments like the US government or Canada or Sweden or something like that. Or municipal bonds, muni bonds as they're affectionately known, which are issued by states and cities. Another common short-term strategy would be to own money market funds. Money market funds are mutual funds that purchase short-term debt from the US government, municipalities, or corporations. If you purchase from municipalities or the US government, there can be tax benefits if that's something that you're interested in. The upside to this type of fund is that the returns can be rather high, typically at around or just over the 2 to 4% mark. A downside to these type of funds is that they are not FDIC insured, like pretty much every other type of mutual fund. People are only really surprised at this because the name sounds so similar to another type of short-term investment option, the money market account. A money market account is a deposit account like a regular checking or savings account, but it will have a higher interest rate associated to it based on the current rate of inflation. The upside to these types of accounts is that they have higher interest rates payable to you than, let's say, a standard savings account, as well as being FDIC insured, unlike money market funds, which again are just mutual funds and not savings accounts. But the downside is that you're limited in how many transfers you can make a month. If you make over the federal mandated limit, you will be charged fees and possibly have your account revoked and transferred to a regular savings account. And to top it all off, there's typically a minimum balance required. But when overall inflation is higher, then money market accounts can really become a better place to put your money compared to a regular savings account. So money market accounts are a great option if you're looking to invest your $10,000 in a relatively safe and tranquil place and don't really need your money right this moment. There are other options if you're looking for higher returns still and are also not looking to need that money immediately. For example, peer-to-peer loans. Peer-to-peer loans are exactly what they sound like, loaning money to someone in a peer-to-peer fashion. Many online peer-to-peer lenders have popped up over the last couple of months and years and have put people who need money in contact with people who have money, and both groups so far seem to be pretty happy with each other. There's a pretty significant downside to this type of investment than the other types we've talked about so far, in that peer-to-peer lending is much more riskier than parking your money into a money market account or a fund or placing it in an online savings account. Through sites like Prosper, borrowers are classified by their credit worthiness, which can help to minimize the risk, but not eliminate it. So you can limit your exposure to borrowers who only are in the upper credit tiers, but there is substantial risk of default and not getting your money back. Hey, at least you know what it's like being on the other side of a credit report for once. But like with a lot of things, if you only choose low-risk borrowers, your returns will likely be not as exciting. But if you're looking for exciting investments, you're looking in the wrong place if you're looking at any of the short-term options I mentioned. In fact, you may want to think about the strategy you are employing for investing your $10,000. With $10,000 to invest, you're in a place where you don't have to scrounge around and look for extremely risky bets or fractional investing strategies, or even stick to investments that have measly returns. You need to ask yourself, what do you plan on doing with the money that you invest in once your investment vehicle matures? And if you'll need that money in the near term or in the long term. Basically, you need to understand what your investment horizon is. What do I mean by investment horizon? Generally speaking, in the financial industry, it's the time frame for when you're going to need the payout of whatever instrument you're invested in. For younger people generally under 45, let's say, your investment horizon can be pretty large if you're looking to invest for retirement anyway. Anywhere from 20 years for people 45 years of age to 25, 30, or even 40 years for younger people. A lot of folks only invest to retire. Me personally, I do not plan on retiring. I plan on doing what I love doing till I drop dead. So I have an investment horizon longer than most. It's practically infinity as a matter of fact. But some people have a much shorter investment horizon. 15 years, 10 years, 5 years. Not just because they're closer to retirement, but maybe they have their eyes on a different prize. Like they're investing their money to make a large purchase. For example, to put a down payment on a house, or perhaps you're looking to start a business and need some extra money. In those cases, the investment types that I presented earlier are perfect for you. If you're not going to need that money for 10, 15, 20 years or more, you have the luxury of being a bit more speculative for the money that you're going to invest. For example, with index funds or ETFs. Index funds and ETFs are great ways to invest $10,000 or more so that your money grows at a nice, healthy percentage. Index funds are a type of mutual fund, and a mutual fund is really just a basket of stocks picked by a company that you pay the privilege of being a part of. They are called index funds because, unlike other mutual funds, these funds are designed to mimic an index which they are following. For example, the Russell 2000 index, or the S&P 500 index, or any other number of indexes out there. Purchasing an index fund is a great way to get an immediate diversified investment portfolio that can and will grow with the market as it continues on its merry way. The downsides of index funds is that since they are pegged to an index, when that index goes south, so does your investment. But that's why you should have your money in one of these when you have a long investment horizon, 5 years or longer as a matter of fact. It's typically best to get into one of these funds when you have 25 years or more of solid earning time ahead of you and continue to contribute to that fund so as the years go by to really maximize the potential gains and potential wealth building power of an 8% annual average growth rate. It's the same with ETFs, except ETFs aren't really mutual funds per se. They're truly a basket of stocks that are traded similar to stocks on indexes. They have similar pros and cons to index funds, plus one or more pro and one or more con, which is sort of the same thing. That is, they can be traded whenever the market is open, meaning you have more options to buy and sell when you are so inclined. Also, you can buy and sell when you are so inclined. Why is it both a positive and a negative? Well, it's a positive because you have more liquidity. There is a true market for these ETFs. The downside is, most people are inclined to sell when the stock market goes south, which is the worst time to sell, particularly when you have a long investment horizon, or even a short investment horizon. Really, whether you're investing short-term or investing long-term, you need to understand the fundamentals, like time in the market beats timing the market, where timing the market means trying to buy when prices are low and sell when prices are high. Start getting those fundamentals down by watching channels like this one, Finance Squared, where we try to make investing principles as easy as your ABCs, your 1, 2, 3s, and or your do, re, mi's. In case of being vague here, subscribe to the channel with post notifications turned on so you don't miss a new video when they're published. And be sure to like this video if you liked this video, and leave us a comment with the ways in which you are going to invest $10,000. We're all dying to know, folks. And be sure to share with your financially savvy friend. Or maybe you have somebody in your life who could use a good and entertaining channel, helping them to brush up on all things personal finance. Either is good, both is better. And remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. Thanks for watching, guys. I'll catch you on the next one. Peace.